Yeah, thanks, Steve. Indeed, we've gone from expecting a recession to no landing as a consensus scenario. We're still on the cautious side. We think that we're living on borrowed time here a little bit, and therefore, consumer strength continues a little bit, just because of labor market strength. It's running on fumes, and then you have that fiscal support, of course, coming from the U.S. government, right? No presidential candidate is going to cut spending, but at the same time, the bond vigilantes are probably lurching around thinking, well, okay, are we still okay with paying just 4% for a government that's actually overspending continuously? So that will at some point come back to haunt them, but it may not be 2024, it may be 2025 before you're actually going to see that in the economy.
And it speaks in your notes so loudly that you're a nervous holder and we're in the final phase of the equity rally. Should we be out of equities if we're in the final phase then?
No, we're still in equities. We still think that also based on the post-COVID money printing, that there is still too much liquidity hanging around there. And you see it still in money market funds. So that's also still high-powered money that could come to the equity market. Of course, there's a good narrative in the equity market with AI now. And that means that momentum is also a part of our investment process. That, yes, valuations, particularly in the US, and I should emphasize that it's not elsewhere. It's just in the US that equities are really expensive. When you look at Japan, Europe, and emerging markets, actually equities are not that expensive. So we can see reasons to hang on for now with positive momentum coming from flows as well as decent valuations outside the United States.
Can I ask you about the AI story, because you've mentioned some of the hype and compared it to the Gartner cycle here around innovation. I've been asking the question all week, trying to ascertain where we're at, particularly with chips, where you've seen a ton of the enthusiasm so far. Just where are we at in the hype cycle, for instance, when it comes to big chip players like NVIDIA?
Yeah, that's a tough question to answer. I would say that you're pretty high up there. What we are really waiting to see is to get some economic signs also that you see productivity improvements arising from AI applications to make that a credible thing for the future. When you look at stock markets now, then you think, okay, well, this is just, dare I say it, just semiconductors, right? So semiconductor demand is super strong. People are over ordering, and NVIDIA gets the benefit of that. And at some point, you'll get an inventory correction. And then, I think valuations will not hold up. So that's the nervous part from the AI hype cycle that I'm seeing.
The other part of the story, too, is the partnership story. Meta. We've seen enormous performance in Meta. It has been one of the AI players, and it's partnering with everyone to ensure its technology is also part of the AI story. Do you like those stocks more?
Yeah, well, if everybody talks about the Magnificent Seven, and I'm saying, well, you should scratch some of them off already, and you're basically down to Magnificent Four now. So those are still, well, maybe running on fumes, but they're running on a good story. But I think that a correction could be anywhere around the corner. But it could also be a melt-up. But I'm just thinking in NASDAQ 2000, it peaked on March the 10th in that year. This is traditionally the good equity season, so be aware of that. So flows are generally positive through the first couple of months of the year, and that sort of ends in April. So yes, you may have another month or so, but that's not enough. But definitely we are nervous holders because of that.